Welcome back, everybody, for another deep dive. Today, we're going to be going through Chapter 7 of Trading in the Zone by Mark Douglas.
Oh, yeah. Trading in the Zone, that's a classic.
Yeah, it's kind of a must-read for anybody who's getting into trading, I feel like, and this chapter is all about thinking in probabilities.
Probabilities, huh?
Yeah, so basically the idea is that, embracing the randomness of the market is actually the way to get a real edge. So we're going to unpack some of these ideas and hopefully come away with some strategies for winning, even when it feels like everything is left up to chance.
Sounds good.
All right, so what are some of the key takeaways you got from this chapter?
Well, I think the thing that really stood out to me was how Douglas tackles this idea that you can actually get consistent results in a field that's as unpredictable as trading. Like, how is that even possible, right?
Right.
So he uses this really interesting analogy with casinos.
Casinos, okay. I wouldn't think of those as a model of consistency, all those flashing lights and slot machines.
Yeah, I know what you mean, but think about it for a second. Casinos are basically built on pure chance, right? Every roll of the dice, every spin of the roulette wheel, every hand of blackjack, it's all random. You can't predict any single outcome.
Okay, yeah, that's true.
But here's the thing.
Yeah.
Casinos consistently make a profit.
They do.
So how do they do it? They figured out how to leverage what they call the house edge.
The house edge.
Yeah, basically it means that even though any individual outcome is totally random over thousands and thousands of bets, that slight advantage, that the casino has guarantees that they're going to make money in the long run.
Interesting. So you're saying that the stock market is kind of like a giant casino.
Well, not exactly. Obviously, there's a lot more going on in the market than just pure luck. But the principle is similar. Each individual trade is kind of like one spin of the roulette wheel. It's unpredictable on its own. But if you have a well-defined edge, a solid strategy over a large enough number of trades, patterns start to emerge, and you increase your likelihood of profitability.
Okay, so that casino analogy is starting to make sense. But if each trade is basically random, how can a trader actually create that edge that you're talking about?
That's where market analysis comes in. A trader's edge comes from their ability to analyze the market effectively.
So they're looking at charts and indicators trying to spot trends?
Exactly. They might use technical analysis, or they might focus on fundamental analysis like a company's financial health or industry trends. But the goal is always the same, to identify patterns and create a strategy that gives them a higher probability of success.
Okay, so it's kind of like learning to read the signs that the market is giving you and then coming up with a plan based on those signs.
Exactly. But here's the thing. Even with the best analysis in the world, you can never totally eliminate uncertainty. Douglas actually emphasizes this point. He says it's all about thinking on two levels, what he calls the micro and the macro.
Okay, micro and macro. I like that. What does that mean exactly? So at the micro level, you have to accept the randomness of each individual trade. You're going to have some wins and you're going to have some losses. That's just the nature of the game.
All right, so you're saying that even if I've done all my research, I still have to accept that each trade is a gamble in some ways.
Exactly. And then zooming out to the macro level is where your edge really starts to come into play. Over a series of trades, if your strategy is sound, you should start to see the probabilities tilt in your favor, leading to more wins than losses.
So it's like flipping a coin. I might not be able to guess heads or tails on any single flip, but if I flip it enough times, I know that in the long run, it should come out to about 50-50. So even though each trade has that uncertainty over time, a good strategy helps me come out ahead.
Exactly. You got it. But remember, we're not just flipping coins here. A trader's edge isn't static. It needs to constantly evolve as the market changes. What worked last month might not work this month.
Right, because the market is always changing. Exactly. And this is where a lot of traders get tripped up. They get stuck in the past clinging to what used to work, or they get spooked by a couple of losses and completely abandon a strategy that's actually perfectly sound.
Yeah, so emotions can really get in the way.
Absolutely. And I think that's why Douglas spends so much time in this chapter talking about the importance of managing your expectations. When we cling to these unrealistic expectations, like expecting to be right, every single time we set ourselves up for a world of hurt, both financially and emotionally.
Makes sense. It's like you're setting yourself up for disappointment if you're expecting to always win.
Exactly. We become blind to the realities of the market. We start chasing those big wins, and we panic when things don't go our way. And Douglas actually has a really great example in this chapter of a trader named Bob who falls into this trap.
Bob. Okay, lay it on me. What happened to Bob?
So Bob's a seasoned trader. He's a CTA. He's managing a pretty big portfolio. But he has this problem. Despite all of his analytical skills, his returns are consistently lower than they should be.
Interesting. Why is that?
He's great at spotting patterns and creating a solid trading edge. But when it comes to actually executing his trades, emotions take over. He can't accept the possibility of being wrong, even temporarily.
Oh, so even though he has a good strategy on paper, he lets his emotions dictate his actions in the moment.
Exactly.
Yeah.
And it ends up costing him big time.
Yeah.
There's this one instance where he places a trade in the belly market, cork bellies specifically, and he sets a stop-loss order, to automatically exit the trade if it moves against him too much.
Right.
But he doesn't really believe he's going to get stopped out. He's so convinced that his analysis is right, that the market is going to move in his favor, that he can't handle even a small dip.
So he's overconfident.
Exactly. And of course, what happens? The market dips not even halfway to his stop-loss, and he panics. He closes the trade prematurely.
Oh, no.
And guess what? Immediately after he exits, the market reverses and skyrockets in the exact direction he had predicted.
Ouch, that's gotta sting.
Right. All because he couldn't handle a little bit of discomfort. He couldn't accept that he might be wrong in the short term.
So the lesson here is that even with a strong edge, emotions can really mess things up.
Absolutely. And that's why Douglas is so adamant about embracing the inherent uncertainty of the market.
So the key takeaway is don't be like Bob.
Right. Exactly.
Yeah.
And this is where he introduces what he calls the 5 fundamental truths of probabilistic thinking.
Okay, 5 fundamental truths. It sounds intriguing. I'm all ears. Tell me more.
Well, I think that's a good place to take a break, and we'll dive into those truths when we go back.
Sounds good. Let's take a quick break and we'll be right back with more on thinking and probabilities.
So these 5 truths that Mark Douglas talks about,
Yeah.
they're all about really shifting your mindset.
Yeah.
Moving away from this idea that you can predict and control the market, and instead kind of embracing this idea of acceptance and probability.
Okay, yeah, I'm ready to hear these truths, especially after that story about Bob. It's easy to think that emotional trading is something that only beginners do. But clearly, even seasoned traders can fall into that trap.
Oh, absolutely.
Yeah.
And that's why I think these truths are so important. They're like a framework for approaching the market in a more realistic way. So the first one is deceptively simple. Anything can happen.
Anything can happen.
Yeah.
Yeah, I mean, that's kind of obvious, right? That's what makes the market so risky. But I guess it's easy to lose sight of that when you're, so focused on your analysis and trying to figure out the most likely outcome.
Exactly. It's a reminder to stay humble.
Yeah.
To acknowledge that no matter how much research you do, no matter how sophisticated your system is, the market can always surprise you.
So it's like letting go of the illusion of control, accepting that you can't predict the future with 100% certainty.
Exactly. And that leads us to the second truth, which I think is actually very liberating. You don't need to know what is going to happen next to make money.
Wait a minute, hold on. You don't need to know what's going to happen next to make money. That's a pretty bold statement. I mean, as traders, we spend so much time and energy trying to anticipate the market's every move. Are you saying that's all a waste of time?
Not necessarily. The analysis is still important for developing your edge. But what Douglas is saying is that successful trading isn't about being a fortune teller. It's more about having a system that tilts the odds in your favor over time.
Okay, so it's not about picking the winner every single time. It's more about having a strategy that over a large enough sample size will give you more wins than losses.
Exactly. And that brings us to the third truth, which really drives this point home. There is a random distribution between wins and losses for any given set of variables that define an edge.
So even with the best strategy in the world, you're still going to have some losing trades. It's just part of the game.
Exactly. And that's why it's so important to have a solid risk management plan in place. You need to be able to absorb those inevitable losses without letting them derail your trading strategy or your emotional state.
Right. So you're saying that even if I have a really good strategy, I need to be prepared for those times when things don't go my way.
Exactly. And this is where I think Bob's story is so instructive. He had a good edge, but he let a small loss completely throw him off course.
Yeah, he couldn't handle the heat.
Right. And that's where the fourth truth comes in, which I think helps to clarify what an edge actually is. An edge is nothing more than an indication of a higher probability of one thing happening over another.
Okay, so it's not a guarantee of winning every trade. It's simply a way to tilt the scales in your favor, to make it more likely that you'll come out ahead over time.
Exactly. But there's a crucial caveat here, which leads us to the fifth and final truth. Every moment in the market is unique.
So even if you have a strategy that's been historically successful, you can't just blindly assume that it's going to work in every situation.
Right, because each moment in the market is influenced by countless factors, many of which are completely unpredictable. That's why it's so important to be adaptable, to constantly be assessing the current market conditions and adjusting your approach accordingly.
So these 5 truths, they really create a framework for thinking about the market in a more nuanced way. It's not about seeking certainty, it's about embracing probability. But that's a pretty big shift in mindset for most traders, right?
It is. It goes against our natural human inclination to try to make sense of the chaos. We crave certainty, but the market thrives on uncertainty.
So how do we actually make that shift? How do we go from, intellectually understanding these truths to actually embodying them in our trading?
That's the real challenge.
Yeah.
And I don't think there's any magic bullet. But Douglas does offer some practical techniques that can help us bridge that gap between knowing and doing.
Okay, I'm all ears. Give me some actionable advice.
One of the most effective techniques, and something that Douglas really emphasizes, is to start journaling your trades. But not just a basic log of your entries and exits. You really want to go deeper than that. Really delve into your thought process before, during, and after each trade.
So I'm writing down things like, what was my rationale for entering this trade? Did I stick to my plan? How was I feeling emotionally throughout the process? Almost like a therapy session for my trading decisions.
Exactly. You got it. And by capturing all those nuances, you start to uncover your own patterns and biases.
Yeah.
You might notice, for example, that you tend to overtrade after a big win, or that you hesitate to take profits because you're afraid of missing out on even bigger gains.
Right. It's like holding up a mirror to your own trading psychology.
Exactly. And sometimes what you see might not be pretty.
Yeah, that's probably true. But facing those less than ideal behaviors is part of the process, right?
Absolutely. Because awareness is the foundation of change. Once you start to recognize those moments when you're letting your emotions drive the bus, you can then start to take steps to consciously shift your thinking.
So instead of beating myself up over a bad trade, I can use it as an opportunity to learn and grow.
Exactly. You can use those experiences as data points to refine your process. It becomes less about, self-criticism and more about self-discovery.
I like that. So journaling is a great tool, but are there other techniques that we can use to really solidify this probabilistic thinking?
Absolutely. Another powerful method that Douglas talks about is something he calls objective identification.
Objective identification. What's that?
It's basically about consciously reframing your thoughts and language to align with those 5 fundamental truths we discussed earlier.
So instead of saying, I know this stock is going to skyrocket, I might say something like, my analysis suggests that there's a higher probability of an upward move, but of course, anything is possible.
Exactly. You're using language that reflects the inherent uncertainty of the market. And by doing that, you're subtly, but importantly, shifting your expectations. You're no longer attached to a specific outcome. You're acknowledging the range of possibilities.
It's like you're mentally preparing yourself for any eventuality.
Right. And that can really help to take the sting out of those losing trades. They're no longer seen as personal failures, just part of the natural ebb and flow of the market.
Yeah, that makes a lot of sense. And it allows you to stay focused on the process, on consistently executing your strategy, rather than getting caught up in the emotional roller coaster of individual wins and losses.
Exactly. So journaling and objective identification, those are 2 really powerful techniques. But there's another element that I think is crucial for managing those inevitable moments of doubt and fear that we all experience as traders.
Okay, I'm listening. What is it?
It's about developing a pre-trade routine.
A pre-trade routine. Okay, so like some kind of ritual that I do before I enter a trade.
It doesn't have to be anything too elaborate, but it should be something that helps you get into the right headspace for trading. Maybe it's reviewing your training plan, visualizing successful trades, or taking a few minutes to practice mindfulness and clear your head.
So it's like creating a mental buffer between my everyday life and the intensity of the market.
Exactly. And the more you practice this routine, the more automatic it becomes. You're essentially training your mind to respond to the market with clarity and focus rather than just reacting impulsively.
That makes sense. But even with the best preparation, there are still going to be those times when you're in a trade and the market starts moving against you. The doubt creeps in, the fear of losing money. How do you stay disciplined and avoid making an emotional decision in those moments?
That's where having a rock-solid risk management plan is absolutely essential. Before you enter any trade, you need to know exactly where your stop-loss order is going to be. And once that order is set, you have to commit to honoring it, no matter how tempting it might be to move it.
No second guessing. No chasing losses or trying to convince yourself that the market is going to turn around.
Exactly. because bending the rules even once can erode the foundation of your trading discipline. And without discipline, even the best strategy in the world won't lead to consistent success.
Right. It all comes back to having a plan and sticking to it, no matter what.
Exactly. It's not about being right or wrong on every trade. It's about managing your risk, staying disciplined, and allowing the probabilities to play out over time.
This has been a really insightful deep dive into the world of trading psychology. We've gone beyond just the mechanics of trading and really explored the mental and emotional aspects of navigating this complex and often unpredictable market.
Yeah, I agree. And I think Douglas's work is so valuable because it really highlights the importance of the mental game in trading. It's not just about having a good strategy, it's about having the right mindset.
Absolutely. So for all of you listening out there, remember, it's not about trying to predict the future. It's about having a well-defined strategy, managing your risk, and most importantly, trusting the process. Thanks for joining us on the deep dive, and until next time, keep exploring, keep learning, and keep diving deep.
So we've talked a lot about the power of thinking and probabilities and how it can help us make better decisions in the market. But how do we actually put this into practice?
Right. It's one thing to understand the concepts, but actually applying them in the heat of the moment, that's the real challenge.
Exactly. So what are some concrete steps that we can take to really integrate this mindset into our daily trading? Well, one of the things that Douglas really emphasizes is the importance of journaling.
Journaling. Okay.
Yeah, but not just like a basic log of your trades. You want to go deeper than that. Really explore your thought process before, during, and after each trade.
So I'm writing down, what was my rationale for entering this trade? Did I stick to my plan? How was I feeling emotionally?
Exactly.
Yeah.
It's almost like having a therapy session with yourself.
Okay, interesting.
Because by capturing all of those nuances, you start to uncover your own patterns and biases. You might notice that you tend to overtrade after a big win, or that you hesitate to take profits because you're afraid of missing out on even bigger gains.
Right. So it's like holding up a mirror to your own trading psychology.
Exactly.
Yeah.
And sometimes what you see in that mirror might not be so pretty.
Yeah, probably true. But you have to face those things if you want to improve, right?
Absolutely. Because awareness is the foundation of change. Once you start to recognize those moments when you're letting emotions drive the bus, then you can actually start to take steps to shift your thinking.
So it's less about beating yourself up for past mistakes and more about just understanding your own behavior patterns.
Exactly. Think of each trade as an experiment. Win or lose, it's a chance to gather data and learn more about yourself as a trader. And over time, those small adjustments and shifts in perspective can really lead to big improvements.
Okay, so journaling is a great tool for self-awareness, but are there other techniques that we can use to really solidify this probabilistic thinking?
Absolutely.
Yep.
Another powerful method that Douglas introduces is something he calls objective identification.
The objective identification. Okay, I like the sound of that. What is it?
It's basically about consciously reframing your thoughts and language to align with those 5 fundamental truths we talked about earlier.
Oh, right. So instead of saying, I know this stock is going to skyrocket, I might say something like, my analysis suggests there's a higher probability of an upward move, but of course anything is possible.
Exactly. You're using language that acknowledges the inherent uncertainty of the market. And by doing that, you're subtly, but importantly, shifting your expectations. You're no longer attached to a specific outcome. You're accepting the range of possibilities.
Right. So it's like you're mentally preparing yourself for any eventuality.
Exactly. And it really helps to take the sting out of those losing trades. They're no longer seen as these personal failures, just a natural part of the process.
Takes the pressure off. You're not expecting to be right all the time.
Exactly. It's more about focusing on the process and executing your strategy consistently.
Okay, so journaling and objective identification. Those are 2 really powerful techniques. But even with all the mental preparation in the world, there's still going to be those moments when you're in a trade and the market starts moving against you.
Oh, for sure. It happens to all of us.
Yeah, and those feelings of doubt and fear, they can creep in so easily. So how do you stay disciplined in those moments? How do you avoid making an emotional decision?
Well, that's where having a rock-solid risk management plan is essential. Before you even enter a trade, you need to know exactly where your stop-loss order is going to be. And once that order is set, you have to commit to honoring it, no matter what.
No second guessing.
Yeah.
No chasing your losses.
Exactly, because every time you bend the rules, you erode your discipline. And without discipline, even the best strategy in the world won't lead to consistent success.
Right. It all comes back to having a plan and sticking to it.
Exactly. It's not about being right or wrong on every trade. It's about managing your risk, staying disciplined, and letting the probabilities play out over time.
Well, this has been a fascinating deep dive into the world of trading psychology. And I think we've really only scratched the surface of what Mark Douglas covers in his book.
Oh, absolutely. There's so much more to explore.
Yeah. But hopefully our listeners have gained some valuable insights into how powerful the mental game can be in trading.
Yeah. And remember, it's not just about having a good strategy. It's about having the right mindset.
Absolutely. So for all you traders out there, keep practicing, keep learning, and most importantly, keep your head in the game. Thanks for joining us on the deep dive, and we'll see you next time.